Welcome everyone. Today I'm going to do a deep dive on Lululemon after the company reported second earnings results. As you can see, the stock is down by 20% after the company cut guidance both on the top line and the bottom line. In this video, I'm going to go through the earnings call. We're going to see what is the upside, what's the downside, what are the fundamentals, and of course, we're going to look at the business model as well as the consensus that Wall Street has for the next 2 years, 2.5 years. Overall, I'm not bullish on the company, and I'm going to explain in this video why. So let's start first with dessert, which means we start with the downside analysis. As you probably know, fiscal 25 guidance was cut, both on the top line and on the bottom line as well. So top line is revenue, bottom line is EPS, if you didn't know that. Looking at second quarter EPS, that was a beat. However, the company missed revenue guidance. Okay, let's have a look at more details to see by how much they missed the guidance. So if we go to revenue, all right, we have, it's not a lot, 0.6%. And in terms of value, it's about 40 million. So yeah, they missed the consensus on revenue, but 14 million, when you talk about an amount that's 2.53 billion, 14 million is nothing, it's 0.6%. So I wouldn't consider this as a red flag. And on the on the bottom line, the company is surprised by 8.3%, okay, 8.4%. So the estimate was 2.86, and they delivered $3.10 in earnings per share. Okay, good, great, that looks good. However, for the guidance for fiscal 25, it seems that the revenue is down to this range, okay, which is 2% on the lower end of the range and 4% at the top. So that growth, let's assume the middle point, which will be 3%, that's really bad because the growth of this company in fiscal 24 was 10%. In fiscal 23, I think the company grew by 15%, I believe, or 16%. We're going to see this in a moment. But yeah, the growth is slowing down, and that's not good for many reasons. But especially during a broader bull run, the one that we have right now, we're in the middle of an AI super cycle. Investors are looking at a few stocks. And if your stock is not growing by double digits, who the hell cares about what the company does? But let's do a deeper analysis. Usually this is not always, but in my investment style, when I see this, I just close the book and I move on. All right, because I'm not interested in mid to low single digit growth. There is something interesting because if you exclude the 53rd week from that guidance, from the comparison with 2024, because 2024 had 53 weeks, right? And if you exclude that and you do a fair comparison, growth will be 5% at the midpoint. Not a lot, okay? So not a lot. Let's use this range because I do believe it's more fair. 5% growth is not what I want. So Americas, this is one of the segments, was flat to negative 1%. US between negative 1 and negative 2%. Canada flat. I believe this is the guidance for fiscal 25. China mainland 20% to 25%. Okay, China seems to be in the double digits. That's good. And the rest of the world is 20%. Okay, at this stage, what I usually do, because here we can already see some of the segments and subsegments, I want to know which is the segment that accounts for most of the revenue, because that segment is the one that I want to see growth. So if China is the main segment by revenue, if I see this growth rate, oh, that's great. I'm suddenly opening up the book again. So let's have a look. Let's understand what is the weight of each segment to the top line of the company. So I'm going to look at the annual. Yeah, let's look at the annual time frame. So we have revenue by geography. You have the United States, Canada, Mexico, Hong Kong, China, and then you have outside of North America. There you go. So this is per continent. I think this is better because I don't have to add up all that. So Americas is almost 8 billion. China, 1.5. You gotta be kidding me. And the rest of the world, 1.5. So essentially, what we have seen earlier is China and the rest of the world are growing in low to mid 20s%, whilst Americas, which is the main segment by far, and in fact, you can click here on the common size, and if you look at Americas, it's 73% of the revenue generated in the last 12 months. That's a lot. So the other two, 13 and 13%. And yeah, Americas negative, flat to negative 1%. That's the reason why they downgraded the guidance. It's because America doesn't look really good, huh? So fiscal 25, diluted EPS, there was another cut versus 14. So that was the midpoint in 2024. 14. Wow. So the top, the upper range of this guidance, all right, $13, it's below what the company achieved in 2024. All right. So that's attrition in the bottom line. I think it's now worth to have a look at what the street expects. So you probably know what you're seeing on the screen. I'm just going to clarify for those of you guys that are new to the consensus and you know what the heck are these numbers on the page. These are analysts. Okay, so you have here 20 analysts that work for institutional funds, usually are based in Wall Street, and that's why usually these are called the street's expectations. So this is what Wall Street believes the company is going to do in this case, in the next quarter or in Q4 and so on. So here you see the number of analysts. Of course, the more far you go, the least analysts you have, because some analysts are skeptic on projecting guidance, for 2 years, because who knows what's going to happen in 2 years, and I agree with that. So usually I like to see at least, 5 analysts in order to have a little bit of confidence in this guidance. So Wall Street is expecting $2.20 for Q3 this year, which would represent a decline of 23% year over year. That's crazy. 18% down if we look at Q4, and 13% down if we look at Q1 next year. So we have a double-digit compression for the next 3 quarters. Wow. That's crazy, huh? That's really bad. And I believe tariffs is one of the reasons why we're going to see it in a moment. At the top line, in regards to revenue, the estimate is 248, which means 3.54 year-over-year growth. That's bad. Q4 negative 1%, and that's the quarter ending in January 26. So they expect a very low compared to 24. They expect lower performance during the holiday season. And guess what? During the holiday season is when you're going to buy your girlfriend those yoga pants. So I think the street is expecting that less guys are going to give gifts to their girlfriends. Interesting. Negative 1% during the holiday season. That's bad. I mean, that tells you off the bat that the company doesn't have anything in the near term, no catalyst, no product, no strategy to grow. We're going to see that as well, because we're going to look at an upside analysis to see what's the upside of the company. This is horrible, by the way. Mid to low single-digit growth with a decline during the holiday season this year. Again, in my investment style, I will close the book and put it away. Yeah, so I wouldn't look at the stock from here onwards, but I'm going to give the benefit of the doubt, and let's continue with the analysis. I want to do something really cool, because here management, of course, is not telling you the initial guidance for EPS. They just say that we cut guidance, we cut it to this value, but they don't tell you the initial value. And the reason is to keep investors, chilled as to how much they cut it. So let's do some analysis here. And of course, I'm going to use a friend called ChatGPT. Yeah. Check this out. I want an analysis for Lululemon, and I want to know how much was their initial EPS guidance for fiscal 2025 before the company cut the guidance in the second quarter. Did you see how I use AI? This, checking shit on Google doesn't make any sense, in my opinion. I need to be humble, but I got to say that Google is cooked. And I owned calls, by the way, on Google. I made about 112 or 111% return on the calls. It was approximately 2 months and a half this year. Of course, I bought, I think it was just a few weeks after the sell-off in April, but I sold and I ran away. Of course, it's going to take many years until Google is going to see revenue hit by people like me who no longer use Google. I just go directly to ChatGPT, and you can see here in the reasoning model, you can see that this is browsing the internet. Now you understand why Huang said that he expects 100 to 1000x increase in tokens. Of course, people like me, I pay for ChatGPT. I gotta say, I pay for this, and I make a return that's significantly more. So you can see here the line of reasoning. I'm just gonna continue with the analysis. Okay, it didn't take too much. How much? 1 minute. All right, so we have the initial guidance was 1495 to 1515. Oh my God, that's a lot. So in the lower end of their guidance, 1495, lower end of that initial guidance, that was more than what the company posted in 2024, which is 1464. Wow, that's a big decline. And the upper range was like in 50. The upper range was $15 per share, and now is 13. That's a big cut. Damn, that's a very big cut. EPS cut, September 4th, cut again. Also, they cut it twice. Shit. So it was that value initially in March. In June, it went down to this range, all right? And then you had this value in September 4th. Wow. Doesn't look good. And they noted 240 million gross profit from higher US tariffs and the end of the minimis change. Sorry. All right, we're going to look at that. Of course, this is a long analysis. Don't expect anything quick here. You need to take it easy because this is a complex company. So let's move on. The next one is US demand softness and the negative outlook. Yeah, we already know that. So management is not happy with the US. I mean, how would you be? You're projecting flat to negative 1% decline in Americas. In the second quarter, US revenue was flat and Americas down 3%, which means Canada was cooked. So if we go to Canada, let me go to, where is it? There. I'm just curious to see how revenue changed in Canada. 0.9%. Wow. Yeah. That trend looks quite scary. Okay. So Canada is not growing either. KPI trends. So we have Q2 decelerated, May the strongest, July was the weakest. Traffic slowed in both stores and e-commerce. Ow, that's bad. Even in e-commerce as well. Okay. And the AOV flat to slightly worse. I wonder what the AOV is. So I'm going to do this. There, AOV. So why type when you can write? In the context of Lululemon, what is AOV? Let's see if you know. Average outstanding volume. I gotta say something. I need to look smart. Average order value. All right. Something like, the Air SPU. Was that? I don't know. The average price. So that was down. Okay, let's go back here. So average was flat to slightly worse. So they had to decrease the prices. Seriously, they had to do markdowns. Yeah, because it's the average order value. The amount of a customer spends per transaction over a period of time. So if that goes down for the same volume, it means that the price goes down or volume goes down. Okay. Anyways, that's concerning. Still, lounge and social assortment, franchise fatigue, hitting frequency and conversion. Franchise fatigue, wow. So product life cycles run too long in core, lounge, or social. Casual become predictable, missed new trends. Ooh, maybe that's why there's the revenue stagnating in the US. I don't know much about trends in fashion, but I know you can become irrelevant very quickly. So yeah, not really good that they missed the new trend, whatever that trend is. Less enthusiasm for scuba. Okay, so this seems to be some of their products. Frequency and conversion down. Okay, we already know that because AOV is down. High value guests spending less on these. Okay, on these products, I believe. And just for curiosity, let's see, what's this? Search. There you go. Let's have a look. How much is the price for one of these things? Wow, that's crazy. 89. That's how much is that in USD? Like $140 for that. For a sweater. Of course, they have high margins. I mean, don't get me wrong. We're gonna look at margins in a moment. Actually, let's look at margins now. I'm very curious. If you pay $140 for that freaking sweater, yeah, that's a high margin business. Gross margin 60. Oh yeah, for a retailer to have these margins, yeah, the company is doing a good job in that regard. They're targeting what they call high value guests. In other words, these are not the usual cheap bastards that are looking for discounts. These are people with money that go there and just blow it on random shit. So good, very good. I like that audience. So margins are good. Operating margins, well, how are the operating margins? 22% for a retailer, that's a lot. 23% actually for a retailer. Wow. Net profit margin, 16%. Not bad, huh? Not bad. Let's see the free cash flow margin. Free cash flow to, there you go. Wow, 15%. Okay, this is a cash cow. This seems to be a cash cow. Free cash flow to operating cash flow has got to be, yeah, it was close to 1. Seems like they're investing in CapEx. I wonder why. Well, we're going to see. Okay, high margin business. They sell expensive things to high margin customers. Root causes: over-reliance on core franchises, insufficient balance of new versus existing styles, slow chase capability that disappointed guests. You don't want to hear that word from management, huh? Next term fix, near-term fix limited. Most meaningful impact of a reset expected in 26. Ow. There you go. That's the thesis right there. So the company is saying that near-term fix is limited. I believe they missed some trend. Let's look at the trend, even though I'm not that interested. You know, you don't need to dive that much deeper into a stock, but I'm going to do it in this case because I said this will be a high deep dive. So let's look. In the second quarter, Lululemon management reported that they missed a certain trend, and that was the reason for the decline in Americas. I want to know what trends they missed. So do a full comprehensive research and give me an analysis. Okay, that's going to take probably 2 to 3 minutes. So I'm going to move on to the next topic, but I want to see what trend they missed. Now, knowing that the trend is yoga pants that have, I don't know, these weird designs, who cares? You know, I don't want to know those many details. I want to see the fundamentals. I want to see the growth, and I want to see the catalysts. And the fact that management said that the near-term fix is limited, and most meaningful impact of reset is expected in 26, that's my case there. Again, I can close the book, trash it, move on to the next stock, because until 2026, and you don't know exactly when, the company is not expecting a rebound. Don't get me wrong. I mean, if you look at the share price, let's see. There's a huge difference between fundamentals and the share price. If you look at the share price now, okay, that looks a very strong support level, like a very strong. So that was a peak in 2018. Seems that the panic sell-off during the pandemic, momentarily went below this support, but then it went up quickly. And then you see here, you see how it tested the price it tested this level, which is 160, I believe. Yeah, 160, approximately 165. This is a very strong support. So let me explain. Yeah, even though I'm not very bullish on the stock, check out what happened in April. Yeah, so you have April, stock rallied 40%. Okay, 40%. Even though you will be bearish, stock goes up 40%. And if you're shorting this, you will be in a big trouble. So right now, I wouldn't be surprised for the stock price to retest the low 200s, just because it is at a critical support. But I'm not a trader here, because I cannot time these weird swings, So my time frame is usually 6 months to 2 years. Okay, because in that time frame, if you're sure about your thesis, if you see that the company is directionally going down, you don't care about these swings 40% up and down, because I'm not trying to ride these swings. I'm not a swing trader. Even though I like swings, you can do some interesting things in swing trading. Especially if you have a combination of strong fundamentals, strong narrative, and strong price action, then you can time the swing. But it's a gamble, and I prefer to stay on the sidelines. So yes, stock is going to go up. Don't get me wrong. You're going to see shares probably in the 200s. That's most likely. However, are they going to be in the 200s by year end? Possibly not. So that's my point. And by the year end, it's like 3 months. So let's assume by the end of spring next year. All right, can we see if the analysis is done? Yes. This is the trend. Okay, what trend they missed? So they say Lululemon management said in the US softness came largely from a lack of newness in women's casual lifestyle, their lounge and social. Okay, plus seasonal color updates that didn't land. Yeah, color possibly on those yoga pants or whatever they sell. I think they sell sweaters. We have seen. I think they have a complex portfolio. In fact, I have a slide where you can see exactly what are the different product lines that the company is focusing on. So they do yoga, training, running, tennis, golf, hiking. Interesting. Golf, of course. You're targeting high net worth individuals. So tennis, golf, hiking, they should be on your list. Okay, moving on. So we have plus seasonal color updates. That okay, we already know that. So what trend they missed? I want to know that. It didn't balance core versus new styles and let product life cycles run too long. Seasonal color assortment in response to Q2 seasonal color updates. Go figure. Missed opportunity in silhouettes. Maybe this was the one. Maybe this was the trend, huh? Management's own language. So contextually, the market has been moving toward looser, wider fits. Oh no. I hope they don't mean for the yoga pants. Over form-fitting basics. Another reason, predictable leggings. Heavy lineups felt tired. I understand now. That makes sense. So the change, from what I understand, the change in the trend is that it seems that, I don't know, possibly these are the yoga pants or maybe the sweaters. I don't know what they're referring to, but possibly these are the leggings. Now they're gravitating towards looser, wider fits. Interesting. And of course, the company is very well known for their tight leggings, particularly by a lot of men like me. So, yeah, it seems that they missed this trend. Interesting. Yeah. Well, you get to learn. You get to learn things every day. Yeah. So now women prefer looser fits. Good. Moving on, that's the trend they missed. So industry softness in the US, premium athletic wear, consumer pullback. US premium athletic wear remains challenging with declines in the second quarter. It's quite strange because consumer spending in the US is not going down. In fact, I'm going to open a new chat and let's see consumer spending. So give me a full comprehensive analysis on consumer spending in the US as of September 2025. Let's see what consumer spending, so how healthy is that in the US? Let's move on in the meantime because that's going to take a few minutes. So US premium athletic wear is challenging. I don't see a decline in consumer spending, so this is another downside. Consumer spending less on apparel and performance active wear, more selective and seeking true newness. By more selective, they probably mean more selective on the price. Competitive intensity increasing. Okay, many players across and possibly these are the players that knew how to ride the wave of that new trend, which is wider and looser leggings. Strange. And that's what the company is missing on. Very, very interesting. So there are many players there. Need to be consistently better. Of course. Tariffs. Okay, a big topic. Tariffs and the minimis removal. This is important. So tariff rates increases and removal of de minimis, okay, drove the guidance reduction. So we have the prior assumption, I believe this is from Q1, 40 basis points mitigated impact, assuming 10% incremental tariffs on most countries and 30% on China. So that was the prior assumption. Now the assumption seems to be 220 basis points. My God, that's a huge upgrade, huh? On the impact. We're talking about almost 6x improvement. Bigger hit on margins. That's crazy. So 220 basis points. Mitigated gross margin impact in fiscal 25. That's 170 basis points. 170 of that is from the removal of the minimis. So you probably know the minimis, anything that you import lower than $800, particularly from China, is taxed now. And I don't remember exactly the rates. I'm going to have to look as well. So let's look at consumer. Let's do some analysis here. I want a comprehensive analysis on de minimis as of September 2025 in the US, particularly how much companies are paying for imports less than $800 from China or anywhere else. All right, let's see. Let's go back. So we have 240 million in gross margin impact in 25. So most of the impact, how much is that? 170, 220. Let me just pull up a calculator here. 170, 220. 77% of the headwind. Okay, so 77% of that amount is due to de minimis. Wow. So essentially, I think the company didn't assume earlier that the US will remove de minimis with the introduction of the one big, beautiful bill. Wow. Q3. So we have 230 basis. That's a lot in Q3. 230 basis point gross margin impact from tariffs and de minimis. Okay. So that 220 is for the full year, and 230 impact on gross margins is for the next quarter. Essentially, that means if I go back to the charts on gross margins, sorry if I jump a lot through the charts, but yeah, it's a lot of information I have to cover. So The gross margin was 58%, okay, and management is now projecting a decline of 230 basis points. I believe that's a sequential decline, right? Let's find out a little bit more. Let's look at the earnings call. There we go. So the impact from the minimis, we approximate 230 basis points. We expect markdowns to be 80 basis points higher than in 2024. We expect deleverage. Okay. It doesn't say exactly if that headwind is a sequential. I believe it's a sequential decline in gross margins. Essentially from 58, you subtract 2.3, so you will go to 56.2%, which will be there. Yeah, that's a decline there. No good. And of course, that's the reason why, if you look at the EPS consensus, you got this, which looks awful, in fact, for the next 4 quarters. And by the way, do you know why you see an improvement here in fiscal 23? It's because here, this is the first quarter that is using a comparison to a quarter in the previous year that had these tariffs and had the minimis removed. So that's why you see it's not that the company is going to improve margins next year, it's that the comparison is going to be fair in this regard. Here, next quarter, you're comparing Q3 this year with Q3 in 24, and Q3 in 24, you didn't have tariffs, and you had an exemption on the minimis. So, yeah, this is, by the way, the consumer spending analysis. Let's go back to that topic because I was really curious. Spending is still growing, but slower. July personal consumption index rose 0.5%. That's good. Prices rose 0.2%. Core PCE increased 0.3%, 2.9% year over year. Wow, that's good. Savings rate sits low at 4.4%. Great. Savings are low, which means people are spending money. Retail shows a decent Q3 start. July retail and food services rose 0.5% and 3.9% year over year. Services better than goods, but goods got a July lift. Of July PC increase, 60 billion came from services and 48 billion from goods. Okay, so goods was still okay. It's not like this was 90% of the increase. Labor market is cooling. We already know that. Let's see if they do any revisions to the August, to the August values that we seen last week. I mean, this week, this Friday. Yeah, the revision was quite big in July, as you know. I think it was like 220,000, a revision of 220,000, including May and June, to the downside, of course. So we'll see. We'll see where this lands. Inflation backdrop, CPI up, which is good because that's telling you that people are spending. Core CPI up, okay, 3.1%. That makes sense. Okay, great. So, yeah. From what I'm seeing here, all this is positive. In other words, this reason where is it here? Consumers are spending less. Exactly. So, this reason, this point, the US premium athletic wear market remains challenging. It's challenging despite consumers in the US spending. So it's not a macro headwind. And that's one of my points here. So the decline in Americas and particularly in the US is not because there is a macroeconomic headwind and now suddenly people are unemployed and they spend less. No, yes, there is a little bit more unemployment, 4.3%, which is nothing. Just look at Europe. and yeah, it's a company related headwind. It's not a macro headwind on demand. Okay, tariffs. Let's go back to this. De minimis. Let's see. How much are they paying tax? So, just to be clear, if it travels outside the postal network, pay normal HTS duty plus IEEPA country tariffs. There you go. This is the one. A flat duty per item. 80, 160, 200, depending on that country's effective IEEPA rate. All right, so less than 16%, 16 to 25, or more than 25. Wow. So if you import some yoga pants that cost you, I don't know, $60, you're paying a lot of tax, huh? Let's see, shipments not sent by post. This is the one, China note, yeah. China is a 10% reciprocal plus an additional 20% specific. All right, so China is 30%. Okay, got it. Yeah, 30% of the value they import, but I thought they would import it in batches and not just one. Okay, postal shipments, flat duty per item. Transition window, yeah. Carriers handling postal items must pick one method. Okay, got it. So China is 10%, plus 20% is 30, extended through November 10, unless modified. Postal flat brackets over 25% for $200 item, based on the value of the item. Yeah, that makes sense. Vietnam 20% reciprocal, postal flat brackets 160 per item. Okay, European Union 50% minus the base duty. If more than 15%, no extra. Okay, 10% reciprocal. Canada 35 almost good. Under separate border security EOs, executive orders. Okay, a lot. Yeah, because I believe most of those plants will come from either China or India. Sorry, or Vietnam. So that's a big tariff there. All right, Q3, 230%. All right, we've seen that. 2026, 320 million net operating margin impact expected due to higher tariffs and de minimis. So that's for next year, even after mitigation. So structural exposure, 2/3 of US e-commerce orders were fulfilled via Canada and had qualified for de minimis, less than $800. All right, they rerouted them. That's a very interesting trick. So 2/3 of the imports to the US were orders fulfilled via Canada that qualified for de minimis. Oh my God. Are they dodging around? I mean, of course, in a legal way, not in a sketchy way, but are they dodging around the tariffs? So that's what the CFO said. 2/3 of our US e-commerce orders went through Canada. Most of those shipments will have been under 800 and will have been qualified for the exception. It's a meaningful impact. We're sure that we're looking actively at our DC network, and parts of our mitigation strategy is inventory placement. Okay, yeah. And making sure we're most efficient as we move forward. Oh, I wonder how long are they going to be able to do the trick with Canada? I wonder how long. That's another negative for the company. I don't know. I already see a lot of red flags here. Not very inspired. Moving on, elevated markdowns as I expected because the AOV was down. And if I assume a similar volume, if AOV is down, it means that people are paying less for items. So in the second quarter, markdowns were increased by 60 basis points versus last year and above expected. Yeah, that's bad. Markdown is over 50 basis points versus last year. Oh my God, that's for the full year. And the prior expectation was 10 to 20 basis points. Ouch. More than 2x at the top of that range. Otherwise, it's like 4x at the midpoint, almost 3.5. Markdowns were 80 basis points in 2024 versus 2024. Okay, markdowns, that's bad. Gross margin compression, I can already see why this will go down. You have a combination of markdowns and tariffs. Fiscal 25 gross margin is now negative 300 versus 2024. Worse than prior expectation of wow, 3 times less. The impact will be 3 times more on gross margins. So that's 3 percentage points down. Okay, that's not important. China's softness and guidance moderation, store pressure, and China was supposed to grow at 20%, right? So we've seen it earlier. China was growing at 20 to 25, I think it was the projection. Q2 China revenue at the low end of the expectations, macro headwinds emerging in tier 1 cities. Quarter-to-date China at high end, okay, but Q4 expected lower. In the lower end, the Chinese New Year shift out of Q4 into Q1. Profit mix skewed to e-commerce in China, and stores are more pressured. So even in China, there are still some headwinds. Q4 expected lower in the lower end due to the Chinese New Year shift. Canada softness, we already saw that. So Q4 revenue was up 1%. Similar macro uncertainties, that's bullshit. We already know that the macroeconomic environment is supporting consumer spending. We've seen the CPE, it was up, spending was up, and even though you have more unemployment, this is one of those reasons. Are some of the macro factors affecting demand? Of course, yes, but it's not the majority. Okay, so the macro is not the main reason. The main reason is the company missed the trend, and that's why they see the top line pressured. Traffic deceleration, e-commerce outpacing stores due to clearance, markdowns. Yeah, I told you earlier, AOV was flat. Q2 traffic slowed in both stores and e-commerce. Conversion was steady. Interesting. So they still converted, but you had less people. So I guess those few people were the ones that are recurring customers. Okay. E-commerce growth outpaced stores, partly reflecting higher markdown activity cleared online. That's why. So they did an online clearance. Damn. Wow, that's a desperate move, huh? That's a very desperate move. I mean, if you have to do a clearance in your e-store, I think margins are gonna be down for a while, huh? Elevated inventory, of course, that's why you do the markdowns. Q3 inventory was 1.7 billion, 13% increase, I believe, in units. The outlook for Q3, low double digits. So it's still going to increase, huh? And in dollars, in the low 20. Wow. That's what matters. It's not the units. I care about the dollars. Low 20% increase in inventories. Oh my God. What are inventories what's going on with that? Segments and KPIs, inventories. Change in inventories. Okay, it's not let's look at the balance sheet, maybe. Inventories, there you go. Okay, so inventories are up sequentially as well. It's not very concerning. Let me see the year-over-year change. There, let me remove that. So yeah, they're going up since early this year. 20%. Yeah, they were right. So they expect 20% as well, an increase of 20% year over year in inventories in Q3. That's not a good sign for demand. Definitely not. And of course, if you have more inventories, you're going to have to do markdowns in your e-commerce stores, which are going to screw up the margins. Damn. Yeah. Delayed timing of product-driven recovery. Management repeatedly signals the most meaningful benefit from design reset actions will begin in 2026, implying limited near-term relief. There you go. Let me see exactly what they said, And through these actions, we expect to create the anticipated improvements in our product portfolio and business performance with the most meaningful impact beginning in 2026. Okay. Essentially, is this a hint for people to chill out until early 2026? Yeah. You see, even management is telling you to chill out, This is what I interpret this. I interpret the message as take it easy. 2025 is we're gonna throw the year. Let's see if we survive, and let's see what's gonna happen in 2026. Let's look at the upside. Let's start to be positive. Let's bring some optimism because I'm depressed. Let's see what's going on. Q2 EPS. Yeah, that was the beat on their guidance. Right. If you exclude stock-based compensation, it's still above the guidance. I don't think stock-based compensation is a concern for the stock, right? Right? Why did they mention stock-based compensation? Just for the number to look better? Well, share-based compensation. Oh my God. Well, why did they even mention that? It makes no sense. You see, so they said EPS was still above the guidance because this is adjusted EPS. By the way, what you see here, that's adjusted. So even if you unadjusted for stock-based compensation, they still say that you will have been above the guidance. But stock-based compensation is nothing. If your Palantir will be entitled to say that, but not Lululemon. In fact, in the past quarter, yeah, that went down, share-based compensation, by 1.8 million. Wow. Well, sequentially compared to how much they spent in the previous quarter. Wow. Yeah, I'm not. When management tries to push these little details, it's looking at the smallest, finest detail to see what is the upside. To bring up the optimism. But I don't want to see stock-based compensation. I want to see demand for a new product, a catalyst. Gross margin upside, okay, in Q2, not in Q3, Q4, or fiscal 2025. Performance apparel growth and share gains, performance categories grew in the second quarter, yeah, but not in Q3. China, Q2 revenue, yes, China is good, but China accounts for 13% of revenue, so I'm not that, excited about China. The rest of the world, second quarter revenue. In fact, as I shown earlier, in China, let me just go back to that point. There we go. In China, they expect Q4 to be lower, in the lower end of their guidance due to the Chinese New Year shift into Q4 into Q1. So, yeah, not very excited about that. India, probably that's the rest of the world. Digital revenue plus 9% to 1 billion. And of course, that's because you did the discounts, and that's why digital revenue increased by 9%. That's not a positive thing, by the way, because that increase was due to the markdown and store network growth and productivity. So 784 stores plus 14 net openings in the quarter, 6 optimizations, whatever that means. The company opened new stores. Are you kidding me? They don't see demand, but they open new stores. Oh, I want to see where. Does it tell you? Square footage increased 14%, driven by the addition of 63 net new Lululemon stores since Q2 2024, which includes 18 locations in Mexico. Okay, so it's not in the US. That's fine. That's fine. Maybe Americas includes Mexico. Maybe Americas includes Mexico in the. So this segment. That's America's gotta be, Mexico's gotta be inside Americas for sure. Yeah, America's revenue, which is the main revenue source, and I think Mexico is part of their of that segment. How much is the growth in Mexico? It's new, October 24, so you don't have much. Relatively flat. I mean, when you compare it to February 25, it's almost the same. But yeah, it's an unfair comparison because this is a cyclical market, so it depends on the season. 2025 openings at the high end. Okay, I don't want to see openings. How much? What's the capex of the company? What's the capex? Show me the capex. Capital. There you go. Let's see the capex. Oh, that's a lot. Let's look at the annual to make it clear. Damn, that looks awful. 1.2 billion in capex in the past 12 months. What? Why are they opening stores? If they don't see demand, why are you opening stores? That's strange. 50 new in Americas. Majority in China. Okay, the majority were in China. So of those openings. Oh, okay. That makes a little bit more sense. That makes more sense now. Okay, so 15 were in Americas, nearly half in Mexico. The majority in China. And those were the openings in 2025. Okay, that's fine. That's fine then. Because if the majority are in China, China is growing in the double digits. So yeah, I was just worried that all that goes in Americas. And Americas, you have no demand, too much competition. And it seems that the trend is changing towards loose yoga pants. Go figure. Member base and brand health. Membership, 30 million. Okay. Acquisition and retention across all age cohorts. US guest base up. Newer cohorts. Yeah, I don't see this as a major upside. Product innovation and planned increases in newness. New styles. Okay. We got some new styles. Newness penetration rise from 23 to 35 in spring. There you go. So this newness, it seems that the company is bullish on that. Maybe this is the product line, I believe. Align, no line. Let's see, what's that? Okay, these are yoga pants. They don't look loose to me. Call me crazy. Daydrift. Daydrift, I think I have to clarify Lululemon. Yes, these are the loose fit. This is the loose fit, yeah. All right. So this is the reason why the company is slowing down. It's where it is. The trend is towards this. Interesting. So that's where they're developing, huh? Be calm. Let's see. I hear this quite a lot. Be calm. It seems like it's a t-shirt. Maybe, or the product line is maybe. Yeah, you see what I mean? It's a looser fit. Look at that. Yeah. That's the trend. This is exactly the trend the company is missing. It's the loose fit. Go figure that this is where the industry will end up, yeah. Because you will think that people pay that premium to I don't know. I'm not an expert. Who cares? I'm not an expert on this. I won't give my opinion. Faster go-to-market and chase capabilities. Chase timeline cut by up to 2 months. AI technology mandate to accelerate program. This is not what AI? Hire the chief AI and technology officer. Are you kidding me? This is a retail company. Well, what are you gonna do here? Are they gonna buy the Xbots? You probably know what an Xbot is, yeah? Xbot stock. I forget the name of the company. Realbotix. Yeah. Do you know what this is? Are they gonna buy one of these things? That's crazy, man. Where the industry is gravitating towards, to this. That's insane. A robot. Pricing actions and tariff mitigation levels. Okay, this is interesting. Modest price increases rolling out on a small portion of assortments. Early read pleased 2026 plan offset half of incremental impact via expense action, remainder via pricing and vendor negotiations. Pricing larger than vendor. I don't know, maybe these are for just a few products. I don't think that applies to the majority of products. Strong liquidity, yeah, of course. I mean, when you look at the cash flows, I know this by heart. This is a company that generates operating cash flows. Look at that, of course. And when you look at free cash flow, this is a cash cow. Look at that, 1.5 billion. So that's why a lot of people are interested in buying the dip, because from a cash flow perspective, Warren Buffett will tell you, oh, this is a cash cow. Do they pay dividends, by the way? What do they do with that free cash flow? Let's see. Buybacks and what are dividends? No, definitely not. They don't do dividends. They do buybacks, 3 billion in the last 12 months. But it will be very strange for this company to do dividends. It's a retail, no, they don't do dividends. That's why it was not in the cash flow statement. Yeah, they do buybacks. That's fine. 3 billion. Okay. How much is that compared to the revenue in the past? Sorry, to the free cash flow in the past 12 months? Wow. So free cash flow was 1.6 billion and they bought back 3 billion. Essentially, they took money from reserves, 1.5 billion, to do buybacks. So reserves are going down in that case, right? Let me see the balance sheet. What is the short-term cash and short-term investments? There you go. Yeah. All right. Seems like that's what's happening, right? The company is using free cash flow and reserves to buy back stock. Interesting. I wonder how long they're going to be able to do that, because, of course, if the company buys back the stock price goes up. I wouldn't be surprised to see where this increase came from, possibly buybacks. But yeah, interesting. Right. So I think that's all. If you followed all this video, I think you're crazy. Overall, I'm not bullish on the company. I have to say that the chart looks awful. The company needs a catalyst to turn around the sentiment, and I do not see anything in the near term. Maybe spring 2026 could be something. I believe that this new product line, align, no align, they drift and be calm. Possibly these products could turn around the company in 2026, in spring 2026. So we won't see the results possibly until Q2 next year. Yeah, I'm not really keen on what's going to happen with the stock in the meantime. Don't get me wrong. I want to be direct. Yeah. Is the price going to retest the 200s? Possibly. That means that the price is going to go up by 43% from today's closing price. So just because it goes up in the same way as it did earlier in April, that doesn't mean that the turnaround is happening, right? And I'm not considering to add this stock to my portfolio. It's not. It needs a story, and it doesn't have it. Tariffs and the minimis are pressuring margins. I don't think the Congress is going to to stop tariffs. So yeah, I think that the company is cooked. If reciprocal tariffs and de minimis becomes it ends up rejected by Congress, then I know which stock to buy. Because their margins are pressured a lot, as we have seen earlier, by de minimis. Okay, that's it. Thank you for watching. I'll see you next one.